Hey everyone, it is Evan here from the Trade Risk on Friday, November 2nd, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So it feels good to be back. I have been on the road, tail end of some traveling, finally kind of back in the saddle here. Next week should be up in full production. I missed a few videos this week. For that, I apologize, and hopefully can make it up in this video and catch you guys up with what's going on here in the markets. Let's start with the S&P 500 weekly time frame. We are getting a bounce back here to start off the first week of November. S&P 500 finished up 2.41% on the weekly chart here. As you can see, each bar represents 1 week worth of trading on this time frame. So the big picture is not a whole lot has changed with this week's action. However, we do have some small wins for the bulls here this week. First thing is we did undercut last week's lows. We had a large range this week, so we undercut last week's lows, and you can see we made a nice full recovery back above those lows and closed towards the highs of this week's range here with, of course, a progress of 2.41% to the upside. So a nice undercut reversal, did it on some pretty good volume there and closed near the highs. That is a short-term, at least encouraging sign that some stabilization, some bulls are stepping in here. Now, of course, we were extremely oversold on lots of metrics here, so we know that the most kind of vicious and extreme sudden sharp bounces do occur within the context of downtrends. So we do want to keep that in mind, but still a little bit of stabilization here. We stop the waterfall from continuing to cascade us lower, and that is at least something we need to respect or be aware of in the short term. At the very least, it's some type of line in the sand. But we'll talk more about that on the daily chart. The weekly time frame as it sits here now, bear case is this long-term slope here, this uptrend that has been in place since 2016, the lows of 2016, is broken or was broken, and we continue to remain below this crucial trend line, and therefore we should expect a pullback of a larger magnitude based on the context of this weekly trend. The more optimistic case here is that, look, we failed to break out up here back in September. We tried to break out to new highs above the January highs. Market failed. We're back in this range, and it's perhaps a sideways 2,500 to 2,900, call it, consolidation for the foreseeable future, for the next couple of weeks, couple of months, maybe even couple of quarters, right? If you're so inclined to believe that we could move sideways for that long. So those are sort of the two scenarios there. And of course, the bullish scenario is here is the pullback. We're down about 10 or 11% off of the highs here made just a couple of weeks ago. And now we're going to put in some type of higher low here and kind of lift us back up towards the 2,900, and we'll be making new highs in a couple of weeks or a couple of months or so. Those are sort of the three broad scenarios I could paint depending on if you're bullish, bearish, or sort of just neutral, agnostic to what the market's doing right now. I don't care which narrative you believe. Certainly there's evidence to be made for sort of all cases right now. The point of these videos are, of course, to just explain the different possible scenarios out there to keep an open mind and just to understand sort of the different ways price can certainly fool all of us. So that is the long-term perspective there for the S&P 500. If we are believing at least that we have the goalposts of about 2533, those were the year-to-date lows made in February, and then we have the January highs. I'm still looking at this 2872 level. You may want to call it 2942 at the all-time highs. Doesn't really matter, but whether or not you take the resistance or level to pay attention to up here or up around 2942, we're more or less in the middle of this range. So whether or not you believe we can head back down and retest the lows of the year or back up here, we're in the middle. We should expect some chop, some volatility, and that's exactly what we're getting. So that is the long-term perspective of the S&P 500. If we go down to the daily time frame, again, we did see a little bit of a snapback here this week. We did see, approximately 11% 8% pullback here from the highs of the S&P 500 down towards Monday's lows, and now we've got about a 4% bounce back up. So very kind of healthy, normal trending behavior, trending to the downside in this case, but a nice impulse leg to the downside. Of course, we had this little bounce here on the 11th of October for a couple of days. Then we had another leg lower, and now we're bouncing again. So what we want to pay attention to here is essentially the swing high from the 17th of October. So that would come in right around 28.16. I'm going to switch views here because I think I got a few more lines drawn on my chart here. And this was from last week's video, but this 27.90 to 2800 level, that was an important prior level to pay attention to. We of course overshot that just a little bit here on the 17th, but this general area up here, this 2800, that's going to be a good level to pay attention to. And given where we closed on the session here on Friday, I wouldn't be surprised either way for this market to either make a run up to this 2800 and retest this area up here next week, or if we start to roll back over, we're going to head back down and pay attention to this 2600 level. It's really around 2603. That was the lows here from the 29th. That was Monday of this week. Either way, just like we talked about on the weekly time frame, being in the middle of this longer term range here from 2533 to 2900, we now find ourselves on the daily chart sort of in the middle of sort of a more narrow, shorter term range of, call it 2600 to 2800, and we're again right in the middle of it. So once again, I would expect some chop, some unclear price action. It's going to be tough to navigate. Can you participate? Absolutely. Just mind your position size. If you're bullish, if you're bearish here, doesn't really matter. Just understand that the VIX is a little elevated. It did come down this week. It's trading at about a 20 handle right now, so it was off about 17% of this week. We had about 25 at the opening of the week. We closed just under 20. So again, some subtle signs there that the market is dialing back its protection. If you're bearish, you would say that, look, that is a mistake, and that is the reason why we could certainly cascade lower here, is there is a lot of complacency out there. And again, if you're on the bullish thesis, then, well, you're looking at the VIX, you're saying things are pulling back, we're getting a bounce, we undercut some lows, we're holding. So again, the narrative right now is conflicted. I could make a case for either situation. I personally think it's a time to do less, to position size smaller, or just to be aware of the potential chop here in this type of market environment. As I've said in many of these past couple of videos, you don't have to play every day. You can just certainly sit on the sidelines. Cash looks like a great position when the market is falling multiple percents per week. So that is really the broad scope here for the S&P 500. Getting that nice bounce back. I could see, again, I'm watching this range 2800 to the lows from this week, just over 2600. That's what I'd be paying attention to. Personally, back to this weekly chart here, I was really hoping to see a nice good slam down into this 2600, really undercutting some of the structure here from March, April, right around this 2580, 2590, sub 2600. I would have loved to see just another kind of fast, sharp sort of sell day following up on Monday's action. We didn't get it, but that would have set up just a better rubber band type of stretch trade to the upside. But we got to take with what the market gives us. So let's pay attention to those levels we just talked about, and let's be aware that on the catalyst side of things, we still have the China trade, which is kind of all over the place. It was a seesaw on Friday with the deal is on, a deal isn't on, back and forth, the market responding to that. We also have earnings that are still kind of, we're in season. We did get through lots of the heavyweights this week. So we did get some of the big companies that have finally kind of out of the way, but there's still plenty more in the following week. And then we have the midterm elections, which will be coming up in the next couple of weeks. So there's plenty of catalysts, plenty of sort of uncertainty out there to keep the VIX elevated. Let's also keep that in mind as well. So that is the S&P 500. Most of these other major indices here follow in the same sort of pattern. We just have different levels to analyze. The Russell 2000 did get the sharpest bounce back this week, 4.38%. It was also down the most in leading on the downside over the course of September and October. So a nice strong bounce bounce back here, almost back well, in fact, right back to last week's highs. Didn't quite take them out, but again, a nice encouraging sign. Also notice with the Russell 2000, we didn't undercut last week's lows. We held last week's lows. We didn't make new lows this week. So some small signs there that the Russell 2000, it did lead us to the downside, but it is firming up here first and maybe strongest at this time. We'll have to see. Again, 1 week is tough to just judge that in an absolute fashion. Let's see if that continues to persist here. Let's see if we can take out these highs here, last week's highs, this week's highs in early trading next week. That should give a little bit of encouragement there to the bull thesis, if so. Finally, we have the NASDAQ 100, clear undercut of last week's lows, and then a sharp rebound here, closing not quite at the highs of the week either, but 1.63% of upside progress. And as we mentioned, this index here, only down, well, actually still down 14% from its highs from the lows here on Monday. This bar here on Monday did get all the way down to 160. So we did have a decent sized pullback here, all things considered, about 14% to the downside. And then we've gotten a snapback of close to 7% already. So a good, kind of breakdown and recovery here. We'll see how it handles this 170, 171 area. And then we have the highs here from October 17th up around 178. So just like the S&P 500, if you were to use this week's lows, 160.17 as the low, and then the highs here from just last week, 178, we are right in the middle of it, and you could make a case either way that this market is going to roll over and retest this or run back to the highs here. Either way, so far as we're in the middle here, expect some chop and really just churning up short-term traders there. So that is the market overall. I think we really covered all sort of aspects there, but again, you don't have to play every day. You can kind of sit on the sidelines and wait for clearer signs. Now the TLT here is a market that does have much more clarity in terms of this direction here, as this broke down to new lows for the year. We had a little bear flag form over 3 weeks or so, and now it is back to the lows here on the year, taking out the 112.50 area. So 2.6% to the downside here for TLT. That certainly puts all trends and momentum back in the bear case right now. The trend is lower. It continues to remain lower. So I would not want to be fighting that at this point. It looks like lower prices are here for bonds. Next up, we have oil, which also continued to pull back this week, sharply so, 7% to the downside, coming back down into this 1330 level. One thing that happened here with oil, which we talked about last week, is this trend line that extended from essentially all of this year, late December, was this trend line here. This was the slope at which USO was trending higher here, and we really cut through it this week on accelerating volume. So that is certainly a cautionary bearish event right there. We are down now 4 weeks in a row. We've come off pretty quick from $16 in the USO ETF all the way down to $13.30. So yes, we are stretched. We are oversold. We easily could see a snapback here, especially at this 13.25 level where the market has inflected prior. So if you're active, if you're short term, if you're nimble, there's probably some opportunity here in USO. But for now, sellers remain in firm control for oil. Natural gas, on the other hand, is bucking the trend. UNG did manage to finish this week higher, 1.48%. We actually did do some buying here in natural gas, so we do have a long position here over the course of this week. We did look at this consolidation as a potential continuation pattern. It is still early. It still does need to prove itself, but like the fact that it is holding up here, some good relative strength. It's trying to hang on above this $26 area, and we're going to see if this can continue higher and turn into some type of continuation pattern, giving this room, not looking for just a multi-day trade, really looking to give this some time to really get going here on a potential second leg higher. But we do have some long exposure here in UNG, the ETF outright. Finally, if we go to metals, We'll go to GLD next, which really didn't do a whole lot this week. It was essentially flat, down 12 cents in the GLD. It did undercut last week's lows, and it popped higher into the end of the week, very similar to equity markets there. So we are still holding above this 115 area. That's what we've been mentioning, to want to keep this on track, to keep the bulls sort of in favor here. We'd like to see this market holding above 115. It's doing that, not doing a whole lot more, but it's tough to get it's tough to get short-term bearish until we start falling back below 115, essentially the lows from Wednesday. Finally, silver, if we look here, much of the same. It closed on the week slightly higher, up 5 cents in the SLV ETF. This really hasn't gone really anywhere over the past 2 months nearly. It is off of these lows clearly. It's trying to put in that sideways consolidation, so there are signs of certainly stabilization. Don't want to diminish the fact that there could be some accumulation here, but there is no strong trend to speak of right now. It's mostly sideways, and for me, this is a market where I'm not too interested one way or the other. There is clear, though, short-term resistance at $14. That's what I'd be paying attention to. It's failed, looks like 3 times now as of the close here on Friday at this $14 area. So if we can get through there, shorter-term traders, and looking for a multi-day pop, at least look at that $14 area for some type of inflection. So those are the major markets. Let's get into some of the ETF, some of the sectors from this week. Now we're going to sort based on top 3 performers. That's generally how we look at things. Thinking about changing the way we do this sort of segment up a little bit, but for now we're going to look at the top 3, bottom 3 sectors, and we'll go from there. So top sector on this week was materials, up 6.1%, and this is very much a case of the most beaten down stocks getting some of the nice big rebounds this week, and a pretty authoritative rebound for the material sector this week. You look at the size and range of the past 2 weekly candles, look at the volume that's come in here, and the fact that we took out last week's highs, we closed above it, 6% to the upside. Pretty convincing looking capitulation candle here. This $50 level that we made for lows over the past 2 weeks now are going to be pretty important going forward, but it came at a prior structure area. It took out last week's highs, so some good signs of a washout there in materials. Wouldn't be surprised to see bulls hold on to this and maybe even continue into next week. So good stance there by an area of the market that was really washed out. Again, not an all clear sign, but at least for a nice kind of at least a dead cat bounce, at least some type of multi-day, even multi-week reversal is possible there with the looks of this week's candle. XLF financials, number 2 performer, 4.43%, trying to reclaim this 2630 area. This is an important one, and this is going to be an important area to watch because financials last week really washed out and took out the structure here to make new year-to-date lows, and now we're quickly trying to recover it. So it'll be interesting to see if this was a fake kind of false breakdown, if you will, last week. If we can get above this week's highs, get above 2675, you could have a good kind of shot at maybe a failed breakdown, looking to buy some financial stocks with a stop that's pretty tight. Looking at this broader structure here could be interesting, something to certainly keep an eye on into next week. It's a big area of the market, and that'll be important to pay attention to. Finally, 4.41% was discretionary sector of the market, XLY, also pretty beaten up over the past 4 weeks or so. It had a nice outside reversal day, or reversal week, undercut last week's lows, took out last week's highs. Good stance there, encouraging to see in the XLY as well. We're going to cover IBB just because this was up almost the same, 4.33%, bouncing right at this level that is held many times in the past, this 101 level. Undercut briefly last week's lows, and we closed towards the highs of the week. We sold off so large last week that even though we did bounce back 4.43%, it's still well under last week's highs, but a good stance at this support. We were extremely oversold coming into this $100 level. If you were active, you could take advantage of it. To be chasing now, a little dicier. It's again just kind of really back in this chop zone, so be careful there, but at least a good stance by IBB. On the downside, three sectors that fared the worst this week. First was utilities, minus 0.41%. Really didn't change anything. Still just within mostly last week's trading range. We're kind of sitting in between this $52 and $55 and change area. Lots of previous supply traded in here. So for me, there is certainly opportunity in individual REITs that I'm seeing cross through my scans, but XLU outright, it's certainly holding up relative to the rest of the market over this recent sell-off, but right now not doing a whole lot. Technology, second worst performer. It was still up 1%, almost 1% this week, but on a relative basis, it was in the bottom of the basket here for some of the other sectors. It undercut last week's lows. Looks very similar to the Qs, of course, because the Qs do dominate with this XLK weightings. But we do have, again, a nice undercut and hold. It did come at this prior level in here, the 66 level, which was kind of short-term resistance in here. Not a big level, but it is on my chart. Really more of a short-term level back from April, May that I was watching. So, an undercut doesn't look like it's a convincing bottom just yet, but we have a MACD that's just recently crossed down into negative territory, so it'd still be suspect here, but again, some early encouraging signs at least. And XLE certainly sold off hard over the past 3 weeks or so. Last week it was down 7%, so a 1% rebound here is certainly well within order. It was coming at a prior pretty important structure area around the $65 area, so again, tough to chase, but a good sign of at least some stabilization here. Doesn't excite me, all things considered, however. So that is everything. That's what I have for this week's video. Again, feels good to be back. Thanks so much, as always, for tuning in and watching. If you like these videos, you can subscribe to our YouTube channel every Tuesday and Friday with market recap videos just like this. So hopefully you guys did okay navigating this volatility. Again, let's not get too aggressive one way or the other. I know there's lots of chatter out there of people excited to short this rally. There's also a lot of people that are excited to sort of buy the dip here, thinking that this is the washout. We have seen the lows in the market. I'm not convinced in either case. I think there's, again, evidence in both camps, which is why I rather just be a little more patient and not as quick to push buttons and get involved. So that's it. Thanks again for watching. Have a great weekend, and I will talk to you guys next week.